Hello everyone. In this recording I'm going to walk through how to calculate the weighted average cost of capital for a firm. And the firm that we're looking at today is Coca-Cola. I've got two files open for this. One is a workbook that includes information from Capital IQ, and the second is a document which is kind of a tear sheet from S&P Capital IQ on Coca-Cola. I've edited this down a little bit for our purposes today. Okay, so I'm going to start over here with the workbook. The first page is where we're going to collect all the information and calculate the weighted average cost of capital. And then the tabs down here give us the information that we need. Again, I pulled all of this off of Capital IQ and arranged it in a singular workbook, but all the information is out there on it. So the first thing we're going to talk about is, for the weighted average cost of capital, is the cost of debt for the firm. And what we're going to use is the yield on the firm's 10-year bonds. So in this case we're talking about Coca-Cola. I'm going to start at the end over here, so if you watch my pointer down there, I'm going to go out here to fixed income summary, and you can actually see this on the Capital IQ main page there on the left hand side, where it says fixed income summary, and on that page it'll have this information. What we're looking for here is the benchmark summaries down below, and so we can see here that there's two. One is 5 years out, 5-year maturity date, and one has a 10-year maturity date. This is the amount outstanding in millions of dollars. So they have a bond that's $500 million outstanding, and one that has a face value of $1.3 billion outstanding. And this is the yield to worst. In this case, it is the yield to maturity for the bond, and the S&P bond rating for both of these bonds is A+. So a high quality bond, low yield because of its high quality. So what I'm going to do is go back to my summary page and just put equals and go out to the fixed income summary and select the 1.79. Now what I need to do here, because this is a whole number and we want it in a decimal form, I'm going to divide it by 100 to give us the percentage. So it's 1.79%. Okay. And I will format that. So again, I took the information from that cell and I divided it by 100 to get that in a percentage form. The next thing I want to do is find the effective tax rate, because we're going to calculate the after-tax cost of debt. And to get the effective tax rate, I'm going to use the most recent tax rate from the firm's income statement. So I'm going to put equals here and then go out to the income statement. And let me scroll up just to show you. Here we go. I'm going to move up here. So you can see here the most recent information on Coca-Cola was from the end of 2020, so pretty recent. It is currently February 2021. And I'm going to scroll down here to keep going. Oh, here we go. Okay, so I found the effective tax rate. And one thing I'm looking for here is, is the tax rate, the most recent one, consistent with the past? And it's pretty consistent. So it's 20.3% here, 16.7% the previous year, 21.3% the previous year. A big one here, and it's likely due, it looks like they had some unusual items, maybe some large unusual items that year, resulting in that really high tax rate. So we're going to go ahead and just use that most recent one of 20.3%. It seems pretty reasonable for the company. And you can go ahead and make this into a percentage if you prefer that. And so that's so easy. Cost of debt is often estimated as the yield on the firm's 10-year corporate bonds. If that's not available, there are other methods, but for our purpose today, we're just going to use that. Now we go into the hard part, and this is the cost of common equity, or the cost of equity. We're going to talk about 4 different methods on how to calculate this. 3 have to do with the discounted cash flow approach. So with the discounted cash flow approach, we take the dividend yield, because that is the yield you're going to get, the investor is going to get in the next year just from dividends, or the expected return just from dividends if they purchase the stock today. And we're going to add to that a growth rate. And these are all, in theory, estimates of the capital, the expected annual capital gains rate. So the change in this, the percentage change in the stock price. The three methods we're going to use, and there are many more methods than this, but the three we're going to look at are the historic dividend growth rate, the analyst estimates for growth, and the ROE times retention growth rate, also known as the sustainable growth rate. The fourth method we're going to look at, so those are three methods there. Discounted cash flow is using three different growth rates. And then the last one is the capital asset pricing model. One key thing to remember here is that you don't add the dividend yield to the outcome for the capital asset pricing model. So we're going to put our inputs up here, and then our estimates are going to be calculated down here. All right. So we'll start off with the dividend yield. I've got just a note here that I take this from the tear sheet, so I'm going to go out to the tear sheet here. And there's a lot of good information here on the company. So start at the top here, tells us about the company, how many employees, what the company does, primary industry classification, not a surprise, it's soft drinks, information about where it's located, who are the main investors, large investors in the company. And this is the information we want down here. We're going to come back here later on to get the market capitalization. But for what we want right now, we just want the dividend yield, which is 3.3%, which is a pretty decent dividend yield for a dividend paying company. So as an investor, if I bought this stock today, then I would expect the dividend to give me a 3.3% return in the next year. That's what that tells us. Okay. The remaining portion of the return I would expect from this would come from the growth in the stock price itself. So we're going to look at the three different estimates I have here for growth. The first one is historic dividend growth. For that, I'm going to go out to the tab here that says historic dividend growth. What I have here, let me make this a little larger for you. What I have here is the dividends per share for each of the last 6 years. Now, I just took these from the income statement, but wanted to, put it in a different sheet just to highlight it a little bit. What we're going to do is we're going to calculate the growth for each of the years here. So I'm just going to put equals and then divide the second year by the first year, and that's not right. Let's try that again. There we go. And then I'm going to subtract 1 from that. Okay, I'm going to subtract 1, and that shows us the percentage growth in the dividend. So take 2016 in this case, the dividend for that, which was $1.40 per share for the entire year, and divide that by the $1.32 the previous year, and we get a 6.06% growth rate. We can see here that it's slowing down, but large companies like this tend to grow their dividends in a somewhat structured way, and we can see that here. If we look for 2015 to 2016, the dollar amount of the dividend growth was 8 cents per share, so 2 cents per quarter, which is kind of normal. Then it grows by 2 cents a quarter here for a total of 8 cents, and then it grows by 2 cents a quarter here for a total of 8 cents. And then for 2019 and 2020, they grew the dividend by 1 cent per quarter. Now, not necessarily meaning that this is a long-term slowdown, but in general, sometimes we see this then bump back up and then back down, and they're just kind of following a path to keep a very predictable long-term growth rate for their dividend over time. So now what we're going to do is just take the average of all of these to get the average annual growth rate. So the average annual growth rate for the dividend for a five years of growth, okay, so we have 6 years of dividends to give us 5 years of growth rates, is 4.45%. And now when we think of Coca-Cola as a mature company in a mature industry, they've saturated the market with their product. 4.45% is a decent long-term growth rate. It's an acceptable long-term growth rate. We wouldn't want to see it grow much faster than that, or it wouldn't be sustainable over time. So I'm going to go back to my summary and answer sheet. The historical growth rate is equal to, and then I'm just going to pop back over to that page, historic dividend growth, and highlight that average. The analyst estimates for growth, this is the easiest one. I'm going to go to the tab here that says Analyst Growth Estimate. And in Capital IQ, you can, on the left-hand side, you'll see CIQ Estimates. This is the page that this comes from. And what I like to use, and I apologize it's not larger here, but what I like to use is the median here. Now you can see for Coca-Cola, their median and their mean are the same. So it's 5.14%, which isn't terribly different than the historic dividend growth. And then finally, just to mention that that analyst estimate is for the earnings per share growth. If a company is mature and is stable, we would expect to see the dividends grow along with the earnings per share. Then finally, the last one is the ROE times retention growth rate. This is also known as the sustainable growth rate. The idea behind this growth rate is this is the maximum internal growth rate for the firm if they don't change their capital structure. Okay. If they don't change their capital structure, so they have debt, they have equity, they're not changing that capital structure, this is the sustainable growth rate. Okay. If they wanted to grow faster, they'd need to change their capital structure, probably to include more debt, a little less equity. So the way that we calculate this is we calculate the return on equity for the firm, and we multiply that by the retention rate, and the retention rate is equal to 1 minus the payout ratio. So I'm going to start with the ROE. I'm going to put in here equals, and then I'm going to go to the income statement. I put equals open parentheses. I want the net income, so I'm going to go down here to net income, 7747 divided by, then we're going to go to the balance sheet and pull up the total equity. Now you might choose here between the total common equity and the total equity. Just for the sake of consistency, I'm going to just use total equity in this case. The Coca-Cola has a meaningful amount of minority interest, and so I want to keep that in this case. So that's the ROE, and now we want to multiply that by the retention rate, and the retention rate is equal to 1 minus the payout ratio. So up here you can see in my formula bar, I've got the ROE, that's our first argument, and then the retention rate is going to be 1 minus the payout ratio, and the payout ratio is dividends per share divided by earnings per share. So I'm going to go out here to the income statement, and well, Capital IQ's already calculated for us the payout ratio, which is 91%. So this means that Coca-Cola pays out 91% of its earnings, at least in the last year, paid out 91% of its earnings as dividends. You can see here they have a pretty decent history of paying out most of their earnings as dividends, and we'd expect that again from a mature company like Coca-Cola. And so the value I get here is 3.29%. So not a lot of variation here, and that's fine. For a company like Coca-Cola, we wouldn't expect to see a lot of variation. When you have companies that aren't as large and as stable and as old as Coca-Cola, you might expect to see a lot of variation here. For example, if a company doesn't pay dividends, that historic dividend growth is 0. Okay. If they have very high ROEs, and I'll tell you Not in the due distance past, Coca-Cola had very high ROEs because they were changing their capital structure. And it's still pretty high. It's still pretty high, but they pay out so much in their dividends, of their earnings as dividends, that the ROE times retention growth rate is still fairly low. Okay. I'll show you how we account for very large changes or differences between these estimates. The next one I'm going to show you how to do. So we're going to move on from this, and we're going to use these down below to calculate our cost of equity. But I'm going to show you how to calculate the beta for the firm. Now, if you look at most websites, and including Capital IQ or Yahoo Finance or Google Finance or most of those different websites, they're going to have a beta calculated for you. I tend to avoid using those betas for actual valuation work or calculating the weighted average cost of capital because I don't know how they calculated those. Okay. So I'm going to show you how to calculate the beta for the firm. And I'm going to go out here to the beta calculation tab. Mind you, I didn't put equals there because we've got to do some work out here. So what I've downloaded here is the prices, the stock price for Coca-Cola, that's KO, and for the S&P 500 index. And this is a tracking index for the S&P 500 large cap index. And I've downloaded the prices for 61 months to get returns for 60 months. The way we're going to calculate the return is we're going to calculate the log normal return here because we are calculating returns over a long period of time. Using the gross return won't change the results significantly, but because we're doing this for a 5-year period, I'm choosing to use the natural log of the gross return in order to get my results here. So for Coca-Cola, I'm going to put in equals ln for the natural log, the most recent price divided by the previous month's price, and that gives me a negative return. They didn't have a good month there for January 2021 of negative 12.33%. And just to make things look nice, I'm going to press my format button up here for the percent, take it out to decimal places to show a negative 12.33% for Coca-Cola during the same month. And you can see here I've gone to the bottom right hand corner of that cell. I found the plus sign, pushed down on my left hand mouse button and pulled that over. During the same month, the S&P 500 had a return of 0.63%. And now I'm just going to grab both of those and drag it down to the next to last cell for the prices, and just pull that down. If I went down another cell, I'd get an error message because it would be referring to these empty cells below it. So now I have an array of prices for Coca-Cola for the last 5 years, monthly returns. We see they had a bad month here in March of 2020, where most companies had a bad month. We can see here for the S&P 500, it was just a bad month for everyone there. And then so bad month so this would have been February of 2020, bad month in March of 2020, and then things start to pop back up here. So the beta is the slope of the line, the linear relationship between the returns for the firm and the returns for the market, or in this case the market proxy. We put in the function slope here because, just to take you back a little bit, if you remember slope intercept form, it said y is equal to mx plus b. Okay, and so in this case, our y is our returns for the Coca-Cola, m is our slope, and x is our returns for the S&P 500, and b is our y-intercept. Okay, so what we're calculating here is the m. It's the slope. Okay, the relationship between the returns for the firm and the returns for the market. So I'm going to put in here equals slope. My known Y's are the Coca-Cola returns, so I'm going to highlight those and put in a comma. And then I'm going to highlight the S&P 500 returns and then close that out to get a beta of 0.70498. I'll pull this up so you can see that a little bit better. So that beta tells us that Coca-Cola is less risky or has less sensitivity to market risks than the average firm. So the average firm has a sensitivity of market risk of 1, or beta of 1. Okay, so this one's less sensitive, and that makes sense. Okay, Coca-Cola has been around for a very, very, very long time, and it has saturated the markets that it can get into. You can get Coca-Cola products all over the world. So people that enjoy drinking Coca-Cola products are going to keep enjoying drinking Coca-Cola products, even if we have a recession, even if we have a global pandemic. So the market fluctuations don't affect the demand for Coca-Cola very much, and so that shows up here. It's less risky than average. All right. So now that I've calculated that, I'm going to go back to my summary page. I'm going to put equals and go to my beta calculation and highlight the beta. Now I've got two other numbers in here, and I've provided these for you. The yield on the 10-year U.S. Treasury is 1.29%. I'll make that look nice. There we go. It's very low right now, but that is what it is as of today. And the market risk premium, this is also known as the equity risk premium. I'll just put that out here, aka equity risk premium. So Aswath Damodaran is a famous corporate finance professor at Stern University. Stern School of Business at New York University. You can go to his website Damodaran Online, and he is very well known for calculating equity risk premiums every month, and is widely cited for his calculations. There are other ways to calculate this. There are people that do surveys, and they produce those surveys every month on what people are using for that value. But what the market risk premium tells us is the return that investors require for investing in the average stock, okay, above the risk-free rate. So this is actually pretty low from a historic standard. If we just added these two together, we'd get 6.09%. So the average return over time of the S&P 500 is between 10 and 11% annually. So right now, this would indicate that the required rates of return on the market are low. In my opinion, this yield on the 10-year U.S. Treasury is artificially low. The government for the last 11, 12 years has been holding interest rates down. The Federal Reserve has been holding interest rates down. We did see a bump up in 2019, and then it came back down with the response to COVID. So typically this number here is quite a bit higher, okay, by at least a couple of percentage points. So right now this is going to give us a low value just from this being this number being held down. So now I'm going to go down here, so this is everything we need to calculate the required rate of return on equity from the capital asset pricing model. I'm going to go down here now and make all my estimates, calculate those all up. So the first one is the discounted cash flow model using the historic dividend growth rate. So this is going to be equal to the dividend yield. And make sure to do this because a lot of people will just use the growth rate. They forget to add the dividend yield, but that's kind of important, especially with Coca-Cola. That dividend yield makes up a significant portion of the return. the second one, I'm going to do the same thing, the dividend yield plus the analyst estimates for growth. And the last one of the discounted cash flow ones is equal to the dividend yield plus the retention growth rate. For the capital asset pricing model, we're going to take, if you remember, the equation here is the risk-free rate plus the beta for the firm multiplied by the market risk premium. So I've got my risk-free rate at 1.29% plus my market risk premium multiplied by the beta for the firm. Let me make that look a little nicer too. Wanted to add a lot of places there. So now we have 4 different estimates. The top 3 are the discounted cash flow amounts. The capital asset pricing model is the lowest at 4.67%. And then I put a place down here for other. So other may be, you know, you look at these and you kind of think in your head that, well, I want to use a different number, but that's in line with maybe some of these, or you have a different number in mind, and you can always put it down here. So what I like to tell people is that, you know, we have 4 different estimates here, and we have to determine one, okay? And our goal in choosing the the estimated cost of equity is to find the most accurate estimate, not the highest or lowest estimate. And I run into this sometimes of people choosing the lowest estimate because it gives them, when we're using this for validation, or excuse me, not validation, valuation, or we're using this for valuation, the lowest estimates will give us the highest valuation. But that valuation would be wrong, okay, if we're just choosing the lowest cost of equity estimate because it gives us the highest valuation. Because, you know, the value of a company or an investment is what people are willing to pay for it. And you can arbitrarily inflate that value for your, you know, calculation purposes, but it doesn't mean it's accurate, okay? It's not, and the goal is not to make the company seem worth more than it really is. It's to find what the accurate value is for that company. So in this case, the capital asset pricing model provides the lowest return, and it's not really in line with the other ones. You know, the nearest one to it is almost 2 percentage points away. When I go through this and I look at different ones, we could pretty much scrap the CAPM. The CAPM estimate is low in this case due to the low risk-free rate. I think it would be acceptable here if you wanted to use a long-run average for that risk-free rate. For our purposes today, I just use the current yield on the 10-year U.S. Treasury. But if you went back and found that the average return was a 3%, which would be likely, you could certainly use that average yield over time. In this case, it's due to the low risk-free rate. In my experience, the capital asset pricing model often provides or results in a low estimate, not necessarily an incorrect one, by the way, but just a low estimate for the cost of equity, because the model only takes into account the market risk of the firm. Okay. It doesn't take into account firm-specific risk. It doesn't take into account size risk or value risk or industry risk. So it leaves out some information there. Then we have three other ones here. One's at 7.75%, one's at 8.44%, one's at 6.59%. What I want you to do, and I have a place down below to do this, is to tell me why you're choosing the one you are. Don't use, another note here, don't use an average of the estimates as your estimate. Okay. So we've already said the CAPM model in this case gives us a low estimate, and probably, in my opinion, too low. The average investor in Coca-Cola probably would not be satisfied with a return on their investment of 4.67%. So that's one thing to ask yourself when you look at that. So if you're using an average of these estimates and you're including the CAPM, well, it's a bad estimate. So an average of bad estimates is a bad estimate. What I might do in this case is say, you know, these are pretty close. And so, you know, this is 7.75, this is 8.44. Maybe 8% is a good other estimate here for the required rate of return. Because you've got two that are pretty darn close to that. Or you might go with the historic dividend growth, 7.75%, or the analyst estimates for growth, 8.44%, or even the DCF, 6.59% return. You know, if we were going a little bit more into security analysis here and really analyzing that, we might be able to put together a longer justification for that. But down below, what I ask you to do is just to explain why you chose the estimate that you did. It doesn't have to be terribly complicated. You might disallow two estimates by saying, well, the average return on the S&P 500 is between 10 and 11% a year. We know that Coca-Cola is less risky than the average stock, so it should have a somewhat lower required rate of return, and that would be fine here. So the next step, I've got this this yellow highlighted area here. I want to demonstrate how to put in a list, a drop-down list, to put your estimate in here. And what a drop-down list allows me to do here is to change my estimate for the cost of equity for use in this weighted average cost of capital model very easily, so I can see what happens as I change the different estimates up here. So what I'm going to do here is I'm going to highlight this cell. It's A29. I'm going to go to data. And if you find it up here, it's data validation. That's what we want. Click on that, select data validation. So I went to data validation, and it says allow, and what I want to choose here is actually list. Okay. So I'm choosing a list, and it says source, so I clicked on this little area. I'm going to highlight these 5 cells. So again, I selected list, and then I selected this box here, highlighted the names of each of the estimates. I'm going to press OK. So now you see this little box pop up here, and I can select any of these estimates. Now that doesn't do me a whole lot of good because there's nothing showing up here. So now what I'm going to do is insert a VLOOKUP. So this is a great function in Excel. I love it. I use it all the time. It is extraordinarily handy. I'm going to demonstrate how to use it here. I'm going to put in equals VLOOKUP. And what this stands for is it's vertical lookup. So it's looking at cells within a column. Okay. If it was HLOOKUP, it would look at cells across the row. But we're looking vertically instead of horizontally. The lookup value is going to be the value I have over here in my A column. So what it's searching for this name. My table array is going to be the names of the different estimates and their values over here. So I highlighted that for table array. My column index number is going to be 2 because my values are in the second column. And then the last item here says true or false. Do I want an approximate match or an exact match? Well, in this case, I want an exact match because the names are exact. They're coming from the same list here. Okay. So I want to put in false for the exact match. And that's it. That's my VLOOKUP table. Again, extraordinarily handy. I love using it. And I'm going to press enter, and it says 7.75, which is the value up here. Now I can click on this. If I click on this cell, my little drop down box is going to show up here, and I can change this. You're going to see the value changes here. Did not intend for this to be there, so because we're going to type that up. All right, so now we're getting into the weights. We've got all of our calculations for the cost of debt and the cost of equity. Coca-Cola, like most firms, has no preferred stock, no preferred equity, so we're not going to include that here. So now we're looking at the weights of the capital components, and remember, capital is the investor supplied funds for the firm. In this case, we're estimating the market value of the firm and the proportion of the market value of the firm that's made up of equity and is made up of debt. In our example here, we're going to use the market value of the firm's equity, and this is going to be the market capitalization. Also known as market cap. This is very easy to find. I've got it out on the tear sheet here. If you go out, you can look at, again, Yahoo Finance, Google Finance, Capital IQ. Really, if you have a brokerage account somewhere, you can pull up this information for the company too. It's very available. It's the number of shares outstanding multiplied by the price per share, but it's usually presented as a single number as the market cap. So on the tear sheet, I'm going to pull that up again. Had it up there for a second. Let's try that again. All right. So again, I'm on my first page here. I'm going to scroll down to market cap. So this is the market cap in millions of dollars. So, and it's important to make sure you're using the same reference point there. It's in millions of dollars or thousands of dollars. So the market cap for Coca-Cola is $218,412,500,000. So pretty large company out there. So I'm going to use that number. Just going to plug it in. Trying to make it so I can see both at the same time. Let's see here. Shrink that down a little bit. Doesn't want to cooperate, so I'll just try to copy and paste it here. Or I'll just try to remember it. All right, there we go. 218,412.50 cents. The value of the interest-bearing debt. So here what we want to do is we want to go to the balance sheet. We want to find the items that are interest-bearing debt for the firm. So what we need to do, I'm going to put in equals, and then I'm going to go over to the balance sheet here. Actually, I'm going to undo that really quick because I want to make this balance sheet a little bit larger so you can see it well. It doesn't let me do it when I've got an equal sign on there. All right. So I'll go back here to the summary page, put in equals. The values on the balance sheet here are in millions of dollars, so we don't have a problem there with that matching up. If I look at my liabilities, the ones that are going to be interest-bearing liabilities are going to be my short-term borrowings. Actually, I'm just going to take that out again so I can highlight these for you. There we go. All right. I took the equal sign out so I can, because I want to highlight these for you so you can use it for other companies. Current short-term borrowings, and these are just loans that the firm has taken out. Maybe went to the bank, took out a loan, or issued some commercial paper. But that's an interest-bearing debt, so we want to include it because that's an investor-supplied debt. The current portion of long-term debt. Current portion of long-term debt is if the firm has a term loan or has bonds coming due in the next year, some principal value of bonds coming due. That's going to go into that area there. It's the part coming due of the long-term debt coming due in the next year. And the current portion of leases. These are going to be capital leases. And capital leases are a form of debt financing. It is technically interest-bearing, in a kind of a strange way there. So we're going to go ahead and include that here. Now, for Coca-Cola, they don't have a value here. I'm going to make this, I'm just going to delete this out because when I try to add that in with the little line in there, it doesn't let me for the calculation purposes. So those are all of the interest-bearing short-term liabilities. The current income taxes payable, that's not an interest-bearing debt. It's a result of how they did their taxes. Deferred tax liability, again, that's a tax issue. And other current liabilities, well, they don't have any, so it's not something we need to worry about, but those typically are also not interest-bearing. Our interest-bearing debts out here, our long-term debt, that's going to be your bonds and your other long-term debts like bank debts. And then long-term leases, again, these are capital leases, so we want to include them here. Coca-Cola does not have any capital leases. Okay. So those are our interest-bearing our interest-bearing liabilities. And so we want to include those in our calculation. So I'm going to go back out here to the summary and answer sheet. I'm going to put in equals. Go to the balance sheet, highlight, and add those all up. And just for the sake of completion, I'm including here the blank ones, although it doesn't really have an effect, just to make everything look complete in our formulas there. So you can see in the formula bar up above, I've added all of these. The furthest out column, which is our most recent column here, it's the end of 2020. I've added up the values there. And so now I'm going to press enter and get a value of 42,793. So it's $42,793,000,000 worth of debt. There we go. Okay. So those are the sources of investor supplied capital for the firm. And I'm going to add up those sources right there to get 261,205.50 for the total market value of capital for the firm. And now we can calculate our weights. Our weight of equity is equal to the market value of the firm's equity divided by the total market value of capital. And the weight of debt is equal to the market value of the firm's equity, or excuse me, the value of the interest-bearing debt divided by the total capital. And you must make sure these add to 1. If they don't add to 1, you've calculated something wrong there. Okay. So the capital structure for Coca-Cola is 83.62% equity and 16.38% debt. Okay. And then down below here, like I mentioned before, this is where you would explain your cost of equity estimate that you used. I'll actually switch this up a few times after we calculate the weighted average cost of capital. So our formula for the weighted average cost of capital is that we take the weight of equity multiplied by our cost of equity. So notice I'm highlighting this this cell here, and I can change my estimate afterwards, plus the weight of debt multiplied by the weight of the cost of debt multiplied by 1 minus the tax rate. And we do that because interest for for-profit corporations is tax deductible. So this decreases their cost of debt and actually makes debt increasingly less expensive for the firm. Okay. One thing I want to point out here, and I want you to look for these kind of things, is the yield on Coca-Cola's 10 years bonds is 1.79%. The yield on the 10-year U.S. Treasury is 1.29%. So first of all, if you're looking up a different and you find a different yield, it's probably not right, or it may be the yield to call for a bond if that that yield is less than the risk-free rate. There's something off. Okay. In this case, it's half a percentage point or 50 basis points higher for Coca-Cola than for the risk-free rate, which kind of makes sense. Again, Coca-Cola has a high bond rating, and it's a high-quality, safe company, and so there's a very, very low probability of default. So that the difference there makes sense. So the weighted average cost of capital, again, let me just go over this equation. We have the weight of equity, 0.8362, multiplied by our estimate for the cost of equity, 4.67%, and I'm going to change that here in a minute, plus the required rate of return, or excuse me, the weight of debt in the capital structure, multiplied by the cost of debt, estimated using the yield on the firm's 10-year bonds, multiplied by 1 minus the tax rate to give us the after-tax cost of debt. And that, taken together, is our weighted average cost of capital for the firm. So I'm going to go here, and like I said, I think that value is too low. If I use the analyst estimates for growth, I get a weighted average cost of capital of 7.29%, which makes sense. Okay, I think that's a reasonable estimate. I could use my other value down here. You can see here that changes it to about 7%, or this historic dividend growth, which gives us 6.71%. So in this case, I'm going to use, and again, it's going to depend on the company. So this is not always the best answer. Especially for a small firm, it may not have very many analysts covering it. Their estimates for growth may be wildly out of whack. They could be very different ones for a couple of different analysts there. So you may not want to use the analyst estimates for growth. The historic dividend growth rate, we can see that they've been growing their dividends pretty stably over time. In the last couple of years, it's been lower, and because they tend to be following this trend where for a few years they grew it by their dividend by 2 cents per quarter, and then they've been growing it by 1 cent per quarter. Over the long run, though, I would kind of expect it to go in waves where they increase it by 2 cents a quarter for a couple of years and then 1 cent a quarter for a couple of years. So their recent dividend growth rate for the last couple of years may be a little bit low. But overall, that's probably 4.45%, like I said before, is a decent growth rate for a long-term constant growth company, a mature company. But you can play around with this and kind of get a sense for what you feel like is a good estimate there. And then down here, I'm just going to explain your choice of cost of equity estimate. So in this case, I'm going to say that the analyst estimates for growth is in line with the historic dividend growth rate. And then, because Coca-Cola is a very large firm, a firm that a lot of analysts cover. We know that for large firms like this, the market tends to be pretty efficient. Okay, there's a lot of people covering it. They can come to a consensus on what the expected growth rate is, and so it's more likely for a firm like this that that analyst estimate is probably going to be a little more reliable than for a small firm. There's no spell check in Excel. That receives a lot of analyst coverage. The analyst growth rate is likely to be accurate. And if I saw wild differences between the growth rates here, and really there's not outside of, or excuse me, the cost of equity estimates, with the exception of the capital asset pricing model, there isn't a great big wide range. The retention growth rate may be a little bit low because their payout ratio for the last year was 91%, and it varies over time. It can't get a whole lot higher than 91% for a sustainable payout policy. And so I feel comfortable with this analyst estimates for growth. What I want from you when you're answering this question for another firm is to tell me why you're choosing the one you're choosing, and give me a reason. Please, again, do not just use an average. I'm going to align this a little bit better. And that's it. We calculated the weighted average cost of capital. I showed you where to get all of the information to do this using this workbook and also the tear sheet. If you have any questions, please let me know.